Thank you and good afternoon, everyone. I'd like to call the meeting to order and acknowledge we are in Treaty One territory, the home and traditional lands of the Anishinaabe, Ojibwe, Inuit, Cree, and Dakota peoples, and in the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation in Treaty Three territory. I'd like to introduce the panel this afternoon via Zoom. Kent Seelan and Valerie Verhun. Myself, I'll be sitting as chair. My name is Mike Colotruglio. From the assessment department, we have Alyssa Idarakova.
Peter Hanova.
Sorry, Alyssa. My apologies. I have a hard last name to say too, so I will call you Alyssa for sake of simplicity. And from the administrative personnel, we have Twinkle Sharma. To the Zoom participants of the hearing, please note you are placed in the waiting room until your property is called upon. When it is your turn, you will be admitted into the meeting. Kindly follow along on the City of Winnipeg's Board Revision YouTube channel for the hearing process. Once the host submits you into the hearing, please close or mute your YouTube player. You will then be permitted to speak with respect to your property. Once the hearing is concluded, you can leave the meeting. We'll be hearing application for revision of the assessment roll in accordance with the Municipal Assessment Act. The matters for which revision is requested has been described in each application, and we will limit discussion to those matters. The statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of property are not considered evidence of market value by the Board of Revision. The Board of Revision is appointed annually by council and is independent of it and the city administration. It makes its decisions on the basis of evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the board's decisions with respect to application may be appealed to the Manitoba Municipal Board if matter pertains to assessed value or classification, or to the Court of King's Bench if matter pertains to application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We will then have the assessor's testimony, followed by questions that the applicant may have, and then the applicant's testimony followed by questions. Each side will have opportunity to surmise if they wish. Once all evidence about the application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all applications have been heard, and the board will deliberate in private and make its decisions. You will receive the board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. We'll be hearing items 1 through 3 and 5 on our docket today. Ms. Sharma, please affirm the assessors and the applicant's testimony, please.
For sure. Ms. Assessor, please state your full name.
Alyssa Hanova.
Do you affirm that the evidence you're about to provide at this hearing is the truth, the whole truth, and nothing but the truth?
Yes.
Thank you. Ms. Applicant, please state your full name.
Farah Cates.
Do you affirm that the evidence you're about to provide at this hearing is the truth, the whole truth, and nothing but the truth?
Yes.
Thank you.
Thank you.
All right, Alyssa, I believe we have the first item of the docket being 300 Selkirk Avenue. I'd love to hear your presentation on this, please.
File number is 24-2290, roll number 14010167100. Address is 300 Selkirk Avenue. The owner is Winnipeg Housing Rehabilitation Corporation. The roll year is 2025 with a reference date being April 1st, 2023. The assessed value is $7,782,000. This is an institutional property and it's school tax exempt. The apartment has one building on site, which is 8 stories, and the actual year built and effective year built are both 1973. There are 169 suites and 22 outdoor parking. Going to page 2, we have the May 4th, 2018 sale for $8,260,000. Continuing to page 3. The suite mix consists of 140 bachelor suites and 29 one-bedroom suites. The average monthly rent per unit is $591.70. The gross potential rent from the model-derived assessment is $1,199,968. We have a market vacancy rate of 3.3% applied, and the effective gross income is $1,160,369. The expense rate is 51.38%, and the net operating income is $564,171. And we have applied a capitalization rate of 7.25%. The estimated market value is $7,782,000, and the market value per suite is $46,047. Continuing to page 4, we have our rent comparables. So all our apartments, and they vary in story height. For the year built, we have a range amongst our comparables from 1964 to 1976. And looking at the gross floor area per unit for the subject, it's at 651 square feet. And our comparables are larger, and they range from 920 square feet to 1,008 square feet. Looking at the suite mix of our comparables, we have primarily 1 and 2 bedroom mixes, and comparable 4 is the only one that also has bachelors. Looking at the average monthly rent, it ranges from $856 to $1,434. Looking at comparable 1, we can see that the suite mix is having more 1 bedrooms than 2 bedrooms, and that's why you have, I guess, the lesser rent that appears of $856, and then the other ones contain primarily 2 bedrooms. Looking at the heat-in rent, comparables 2 and 4 do not have that included. Follow me to page 5. We can see the CMHC average apartment rents versus modeled potential rent. And we have this because this property's historical expenses are not typical of what a investor would consider. So we're using the CMHC October 2022 private apartment average rents. So we have in the upper table the CMHC for the zone, and then in the table below we have it for the building year. On page 6, the table above is for the subject unit type. And then looking at the combined averages, on the table below that, we have the CMHC zone, which was combined average of $657, and then the year at 862, building unit count at 944, the average is 821. And looking at the market CMHC potential rent and the model rent, the percentage of market rents here is 72.04%. Going to page 7, we can see just the table from the CMHC market rents. Page 8, capitalization rate evidence. The following is a sample of actual sales that took place during the reference period. The purpose for showing these individual capitalization rates is to illustrate the accuracy of the model and substantiate the model-derived capitalization rates. They are not meant to be comparable specific to the subject property. Net operating income has been developed through stabilizing owner-reported income and expense information. Capitalization rates have been derived by dividing the property's net operating income by its sale price. We see here a range in the table below from 3.46% to 5.74% cap. Page 9 shows more capitalization rate evidence. So we can see for the city of Winnipeg multifamily, between our 20th and 80th percentiles, it's a range of 4.75 and 5.45. So ours subject here has a cap rate of 7.25, which is outside of that range. And then we also see the Colliers, CBRE, and Cushman and Wakefield capitalization rates as well. And we can see that the subject's cap rate falls outside of those parameters also for the high rise. Page 10 shows the Municipal Assessment Act excerpts. Going to page 11, we have the aerial view of the subject property in the purple outline. And we have the location on the map below. Page 12 shows an image from Google Street View, July 2022. And there's some online information. So tenants pay a low monthly flat fee to include all utilities, hydro, water, heat. This is a seniors apartment building. And there is limited paid parking, but there is a bus stop located directly in front of the building for ease of transportation. The suites are rent geared to income and it's subsidized rental suites. Page 13 also shows that there's a bus stop on Selkirk Avenue at Charles Street. There is, it's in the Point Douglas neighborhood. This is seniors housing. That would conclude my presentation. I'm open for questions. Thanks.
Thank you very much. Ms. Cates, questions?
Yes, thank you. So in terms of the property's location in Lord Selkirk Park, would you agree that would be considered a more challenging area of the city?
Yes, and I think that the cap rate factors that in.
Okay. And then in terms of seniors housing, where they typically have small suites and low parking, would you agree that that could be less desirable to the market?
I would say that, well, in terms of a typical market, perhaps, but because this is senior housing, there is a demand for such.
Okay, but if we're looking at it as like a market apartment, like if it's sold and it could be used as market, do you think having a high proportion of really small suites and kind of low parking would be less desirable in that sense?
I would have to say so, yeah.
And then on page 2 with your sale, did you have the opportunity to investigate that sale? And are you aware that it's listed as a non-arm's length transaction?
Just taking a quick look. This sale did have a market value appraisal report completed at the time of the sale for $8,260,000.
Okay, but on your, assuming you have the sales questionnaire open, it is checked off that it's a non-arm's length sale and the actual price paid was different.
That's correct, but there is the market value appraisal report that is confirming the value of 8,260,000.
And then just on page 4, I know the rent's not in contention, but just quickly, your comps 1, 3, and 4, those would be in a different region, more desirable neighborhood than the subject. Would that be correct?
I wouldn't be too sure.
Okay. And that would conclude my questions on this property. Thank you.
Very much. Ms. Verhun, do you have any questions at this point of the assessor?
At this point, no, thank you.
Very well. Mr. Seelan, questions of the assessor?
Yeah, so the capitalization rate of 7.25% is largely because of the area.
I would assume so. I'm not sure what other factors are playing into the cap rate.
Have you inspected this building?
I have not inspected this property.
Thank you. That's all my questions, Mr. Chair.
Thank you very much, Mr. Seelan. Alyssa, I was going to just further down the avenue that Mr. Seelan just went down. With respect to the cap rate, would the fact that the property is made up of mostly bachelor suites, would that not add to the potential cap rate being a bit higher than what you're seeing in the 60 percentile that's normal, and this would take it up into the 20 percentile of the high end of the range? Would that be fair to say?
That could be fair to say.
So between location and mix of the suites, potentially that might help to explain the higher cap rate.
Correct.
Because as we see, the city's cap rates do not have anything as high as that,
No, they don't.
and neither do the
other
outside
brokers,
sources
yeah.
at this point either. That's not in contention though today, is it? Or is there a cap rate dispute in this case?
No, I've gone in with a bit of a lower cap rate.
Well, okay. All right, those are my questions. I guess we will hear from you, Ms. Gates, please.
Okay, thank you. So if you turn to page 2, we have a summary of some of the facts of the property, as well as our requested assessment of $6,556,000. On page 4, under scope of work, we did visit this property. So we have some interior and exterior photos in the appendix.
Recent?
February 23.
Excellent, thank you.
On page 6, we have our property site maps. So you could see the aerial map view and then the Google map view showing the location. And then some exterior photos on page 7 and 8. Page 9, property description. So the subject property is on the south side of Selkirk, where it intersects with Robinson Street and Charles Street in the Lower Selkirk Park area. Property is 8 stories, built in the early 70s. There are 169 units, primarily bachelors, and 22 parking stalls. On page 14, we have the overview of our income approach. So given that the property is social housing and it operates on a rent geared to income basis, the rents achieved by the property are not deemed to be at market. And since we know that the modeled rents are taking a proportion of CMHC rents, we are not disputing the rents. Those would be $1,199,968 or $592 per unit per month. And we should be seeing rents applied to social housing coming in below market rates, because typically the units are smaller and they are known to have utility grade finishes. For the vacancy rate, we're applying 3.3%. And then for the expenses, we have reviewed the actual expenses in place and have stabilized based on 3 years. So we are applying expenses of $701,422 or 60.4% of effective gross income. On page 15, we have a discussion of our cap rates for social housing. So on page 15 and 16, the idea is that these properties don't really transact in the market, and when they do, they have atypical conditions associated. So we can't really build cap rates out of those specific sales. So we look to market rates and then make adjustments upward for risk factors. So risk factors can be broken down into more specific categories, but broadly it would refer to low cost or low quality construction, age, neighborhood, and low income tenancy. So on page 17 and 18, we have a discussion on low income tenancy. The idea is that it leads to deferred maintenance because these properties operate at a loss typically. Their revenues don't cover their expenses and they rely on government funding to fill that gap to remain operational. But then what they don't have the funds for is those preventative repair and replacement items that market apartments would be incentivized to do. And we see that over time, the issues build up and the severity of those issues build up. So a good case study of this was the Manitoba Housing Property 185 Smith, built in the early 70s, high rise as well. Issues were going on for years to the point where they had major damage, tenants had to be relocated, etc. So this is something that characterizes social housing properties, just the lack of funding to address those issues. So in terms of the cap rate on page 19, when we're looking at social housing properties, especially in more challenging areas, we would look to a cap rate in the range of 6.5% to 7% or potentially a bit higher. So in this case, I've applied a 7% cap rate to the analysis to account for the fact that we're also using the actual expenses in place, which are higher. So on page 21, we have our income and expense breakdown. So we are using an effective gross income of $1,160,369 with our total expenses, which includes stabilized repair and maintenance at $1,113 per unit. We have a net operating income of $458,947 with a 7% cap rate, gives an indicated value of $6,556,000. Since this is a 40S property, it is protocol to calculate the class 20 taxes. The idea being that if the property did transact and they were no longer operating it as a seniors housing, they wouldn't have the 40S tax treatment. So that's just a standard protocol for calculating the taxes. In terms of commenting on the sale, when we're looking at sales that are going from Manitoba Housing to other social housing agencies, these are not market transactions and they do typically have a lot of atypical conditions associated, such as large forgivable loans, potential capital allowances, things like that. So especially when they've checked off that it's non-arm's length sale, I don't believe that it could really be relied upon to come up with a value for the subject. So on page 24, that would be the start of the appendix. I've included the photos of the units and the common area. So with seniors housing, we do see excess common area typically. So you can review those. And then I've also included the financials that we've looked at, and then just some further information on our social housing cap rates. And I've also included our standalone apartment cap rate study for your review. And that would conclude my presentation on this property. Thank you.
Thank you very much. Melissa, do you have questions of the appellant this afternoon?
Have you inspected this property?
Yes.
No further questions.
Thank you very much. Mr. Seal, questions?
So what do you suspect is driving up the cost on the repair and maintenance?
Sorry, let me just get to the valuation page. So in terms of the repair and maintenance, being around $1,000, $1,100 per suite would be considered quite low. Typically for like an average market apartment, you'd be at least $1,500. And for really well-maintained properties, you'd be in the range of $1,800 to $2,000. So I would say the repair and maintenance here would be on the low end.
Okay, thank you. That's all my questions, Mr. Chair.
Thank you very much. Mr. Hunt, do you have any questions at this point?
My question was just answered, Mr. Chair. Thank you.
Thank you very much. Do you know, Ms. Cates, about much more about the sale that happened in 2018 by chance?
I did take a look at the sales questionnaire ahead of time.
Was it one social housing group selling it to another? Is that
Yeah,
basically what happened?
yeah, so it was Manitoba Housing to Winnipeg Housing, and Winnipeg Housing was the sponsor manager at the time of the sale as well. So they were like related.
Okay, and was there, because the number at 8.26 million is quite a bit north of both positions today, and I appreciate your comment that there may have been loans or forgivable issues that were between the two parties. But I was wondering, do you know of those items in particular, or is that conjecture on your part?
So to elaborate a bit more on the sale, so the 8,260,000 value, that's based on a appraisal done in terms of the actual price paid. They paid 5.5 million. So they didn't pay the 8 million. And then as I was flipping through the appraisal, they do different value estimates. So they do one as if it was just a straight market apartment, one as if it's they're below market rents. So when they do their value estimate, kind of capturing that social housing feature, their value is coming in much lower than 8 million, around the 4 or 5 million range based on the appraisal. But when they're doing market rents with no level below CMHC to account for different finishes, they're using complete market cap rates. They're not doing any type of associated risk factors. They're coming in quite a bit higher. So it would be a different methodology, but they didn't actually pay that value.
Fair enough. You guys both agree on the value of the rents. And basically, well, you have a disagreement on your expenses by 9%. Basically the two points of difference, as well as a quarter point difference on the cap rate, which you are lower on, which is incredibly awesome to see. I guess you feel that the expenses are higher because of the fact that it is social housing? Is that in essence what you're saying?
So when we do look at the expenses, so the assessor addressed in her presentation, as well as mine, in terms of the rents, that the rents aren't at market, so we don't use the rents. But when we're looking at the expenses, there's nothing really atypical going on with the expenses. So when we're looking at market apartments that operate on the lower end of the rental range, they would typically be including other features, like they would be including all of the utilities, things like that. So we do see the expense ratios on the higher end for these types of properties, but I would say that the expenses are like, they are what they are. They would still be in place if this was market, because if this was running as market, it would still be running as a lower end apartment that would be including utilities and all of those things. And when we look at other expenses like insurance, like waste and snow, things like that, like they
Those
are what they are.
Pretty much set, yeah.
Mhm.
Okay. I think those are my questions. Thank you very much.
Thank you.
Is there any summation on either part, ladies?
Yes.
Go ahead.
So to summarize, I feel that the expense rate that our model has provided of 51.38% is what we're seeing in the market. And just to reiterate that our market rents are only at 72.04% of the CMHC market rents. And going back to that 2018 sale, yes, it's not an arm's length transaction, but they did do a market value appraisal at the time for $8,260,000. That would conclude my summation. Thank you.
Thank you very much. Ms. Gates, any final thoughts?
I'm good, thank you.
Thank you very much. Much appreciated on both behalf. We will move on to the next item on the docket. That will be 18 Inkster Garden. Alyssa, may we hear your presentation on this, please?
File number is 24-2973. Roll number is 14098080000. This is 18 Inkster Garden Drive. The owner is Manitoba Housing and Renewal Corporation. Roll year is 2025 with a reference date being April 1st, 2023. The assessed value is $4,894,000. This is Res 2 and Grant. The apartment has 2 buildings on site, which are 3 stories. The effective year built and actual year built are 1986. We have 40 suites and 60 outdoor parking. Going to page 3, we can see the income value summary. So we have 24 2-bedroom units and 16 3-bedroom units, and the average monthly rent per unit is $1,126.18. Looking at the model derived assessment, we can see that the gross potential rent is $540,000, 566. We have a market vacancy of 3% applied. The effective gross income is $524,349. The expense rate is 54.27%. The net operating income is $239,785, and our cap rate here is 4.9%, and our market value is $4,894,000. The assessment, sorry, $4,894,000, and the market value per suite is $122,350. Going to page 4, we have our rent comparables. So all our apartments, the comparables, they range from the year 1980 to, 1977 to 1996. And looking at the suite breakdown, we can see here that comparables 1, 2, and 3 are primarily 1 and 2 bedrooms, and comparable 4 contains mostly 3 bedrooms as well as 1 and 2 bedrooms. Looking at the gross floor area, the gross floor area per unit, the subject is at 1,108 square feet, and the comparables, they range from 906 square feet to 1,043 square feet. The average monthly rent for the comparables range from $1,270 to $1,444, and we can see here that heat and rent is not included. Going to page 5, again, we have the CMHC October 2022 private apartment average rents. The first table is for the zone, so this one's in the Lord Selkirk area. And then the bottom half of the page is for year of construction, and that would be between the range of 1975 to 1989. Page 6 for the structure size, so the 40 units ranging from 20 to 49 units. And looking at the table below, we see that the CMHC zone has an average of 1,172. The year is 1,361. The building unit count is 1,388, and the average is. We have the market CMHC potential rent, the modeled rent, and then the percentage of market rents that we're at here is 86.14%. Page 7 shows the CMHC October 2022 market rents. Page 8 shows the capitalization rate evidence. So here, the following is a sample of actual sales that took place during the reference period. The purpose for showing these individual capitalization rates is to illustrate the accuracy of the model and substantiate the model-derived capitalization rates. They are not meant to be comparable specific to the site, to the subject property. Net operating income has been developed through stabilizing owner-reported income and expense information. Capitalization rates have been derived by dividing the property's net operating income by its sale price. Within our table below here, we can see the range is from 3.46% cap to 5.74% cap. And subject with the cap of 4.9 falls within that range. Going to page 9, we have more capitalization rate evidence. So looking at the city of Winnipeg multifamily, we can see that we have within our 20th percentile 4.75 and at our 80th percentile 5.45. So again, we are within this range as well. And looking to then we have the Collier, CBRE, and Cushman and Wakefield. Page 10 is the Municipal Assessment Act excerpts. Page 11 shows the aerial view of the subject property. And the bottom half of that page shows the map, which it's situated. Page 12 has Google Street View images from July 2023. That would conclude the presentation. Thank you.
Thank you very much. Ms. Case, do you have questions at this point?
Yes, thank you. So on your income value summary on page 3, do you know if the model is accounting for the property being subsidized housing, or is it valuing it as a market apartment on the lower end of the rental range?
It's valuing it as on the lower end of the range for, I guess, what would typically be a normal apartment.
Okay, and your cap rate at 4.9%, that would be considered the low end of your cap rate range, right? Like it would be fairly close to your 20th percentile?
That's correct. Falls within the range though.
And then page 9 on your cap rate table, in terms of the broker information that's shown to further support your cap rates, they wouldn't suggest anything lower than 5 for like a low rise B property. Is that correct?
That's correct. But looking at the city of Winnipeg, capitalization rate evidence, it does fall within the range. It's not outside of the 20th percentile, it's within the range. And even going to page 8, we see that it falls within the range that we've provided here as well.
Okay. Regarding your sales on page 8, you would just be providing the final values, not the workups or the backup data. Is that correct?
That's correct.
Thank you. That would conclude my questions. And then I would just have some cap rate rebuttal when we get to that stage.
Thank you very
Thank you.
much. And Ms. Brown, do you have any questions at this point?
Mine was on the cap rate too, but I think I'll just wait to ask maybe the applicant. Thank you.
Okay, Mr. Seelan, questions?
My questions have been asked and answered. Thank you, Mr. Chair.
And I will ask, with respect to the cap rates that you show on page 8 of your report, these are cap rates that have been developed by the department, and we have seen these through the cycle time and again. Just please remind me and the panel, when it comes to these particular sales, these were all sales from the marketplace with 3 years, I believe, of stabilized income and expenses. Is that
That's
correct?
correct.
And are these fairly typical from the marketplace?
I would say so.
But the key here is that there's 3 years worth of income and expenses.
That's correct. That's how our department has stabilized these sales.
All right. I just wanted to clarify that, so thank you very much. Ms. Cates. Your presentation at this time.
Thank you. So if you turn to page 2, we have our requested assessment of $3,996,000. On page 6, we have our property site maps. And then some exterior photos on page 7, and then a pictometry view on page 8. So we have a property description on page 9. So the property is on the south side of Inkster Garden Drive, west of Keewatin. It contains 2 3-story buildings built in the mid-80s with 40 units and 60 parking stalls. On page 14, we have the overview of our income approach. So similar to the last property, we're not disputing the income because we understand that it is below CMHC rents to account for the lower grade finishes of these units. So we're applying rents of $540,566 or $11.26 per unit. 3% market vacancy, and we are not disputing the expenses at $284,564 or 54.3% of EGI. We have cap rate discussion starting on page 15 through page 18. So I would just echo my earlier comments on the cap rates, and then just also add that there is precedent to add premiums to these properties, even with lower end rents and higher expenses. So on page 19, we have our cap rate for the subject property. We are doing a 0.5% adjustment to our base cap rate of 5.5. We're applying a cap rate of 6%. There are 2 wood frame buildings. This would be a lower quality construction. And in taking a look at the building condition assessment, there are requirements for about $900,000 in work for this property. So at a property that's valued at around 4.8 million, that would be about 20% of that assessment. So it's not insignificant in terms of the amount of capital required. So on page 21, we have our income and expense breakdown. So with an NOI of $239,785 and a 6% cap rate gives an indicated value of $3,996,000. Appendix starts on page 23, included the building condition assessment, and then just again the background of the social housing cap rates. And that would conclude my presentation. Thank you.
Thank you very much. Questions for the applicant, Melissa?
No, but I also have rebuttal evidence.
Okay, we'll get to Melissa's that in a moment. Mr. Steele, questions at this moment?
Yes, you mentioned that there's $900,000 work improvements required to the building. What work improvements are required here?
So in terms of the specifics, I wouldn't have the specific line items, but where I'm getting that from on page 25, it puts it like the company that did the building condition assessments for manageable housing. They put it into broad categories of what needs to be done. So the bulk of that work is designated to the interiors. So presumably interiors of the units, because this type of property wouldn't really have that much common area. And then the second largest expenditure they're listing for services. So presumably like upgrades to services and systems at the property. But in terms of further detail, I wouldn't have that at this time.
You mentioned, I think, that you increased the cap rate by 0.5 point. What was the reason for the increase again?
So our base cap rate for a property of this age group would be 5.5%. And we look at different factors of these properties. So when we look at those 4 broad factors that we can consider adjustments for, one of them is low income tenancy, which would be present at all social housing properties. The idea of deferred maintenance building up. So when we have a property built in the mid-80s, all the years of not having adequate funding to that property, the deferred maintenance would build up. So that's one part of the adjustment. And then the other part of the adjustment would be to account for lower cost or lower quality construction. When we look at multiple wood frame buildings, that would be considered a lower quality, and typically having multiple buildings on the site would be considered like a less efficient way to build rather than building like a vertical apartment. So that would be the basis of our adjustment for this property.
Thank you. That's all my questions, Mr. Chair.
Thank you very much. Ms. Verheyen, questions?
Mine were just answered, thank you.
And I have a question of curiosity at this point. On page 25, I note that you have this table 2, capital and maintenance renewals. And I see you have the short-term column, but the long-term columns seem to be redacted at that point.
I redacted them.
Did you now? And why would you not show those?
I assumed because we're getting past the date of physical condition, I didn't want to, because when you look at the longer term amounts, they're going to be typically like quite large amounts. So I didn't want to put that with the board. I figure we're dealing with the date of physical condition of 25. I mean, ideally, it would have been 22 to 26 and then
Ideally,
but that was the logic there, just because the amounts get so large when you're looking over the long term.
curious, and I appreciate the comment, and I was just wondering why you wouldn't leave them in, but I kind of understand what you're trying to do at that point, and I appreciate it. I think I'll wait for the rebuttal evidence that you're going to put in next.
The rebuttals are being shared on the SharePoint. You can refresh your SharePoint.
Okay.
The applicant's rebuttal has been shared with Elisa through email. Do you want the email or the printed copy?
Can I get a copy?
Okay, so AT&T's is here. And
Oh, thank you.
Ms. Kate, so yours is here also. So we'll start with you, Ms. Kate, please.
Okay, thank you. So in terms of our rebuttal, if you turn to page 4, we've gone through the city's cap rates. So in terms of the first two, 727 Sargent and 241 Young, those cap rates are unusually low, 3.46%, 4.21%. Those are lower than what we would typically see in the Winnipeg multifamily market. And without seeing the workups or the backup data, I would suggest that scrutiny should be applied to those cap rates. Typically, when we see cap rates below 4.5%, 4.75%, it's usually that the purchaser is purchasing a different income opportunity, not necessarily the one that was historically in place. And then we've gone through the other cap rates and where we're able to find information through a combination of market information, interviews with purchasers. We've gone in and restabilized the cap rates based on the presumption of what the purchaser would have been purchasing at that time. So for 459 Sargent, still on page 4, we've restabilized at a 5.79%, which would make more sense given the age and area. If you turn to page 7, 150 Hendon, the city is at 4.01%. This is a mid-70s property. We've restabilized at a 5.42%. And this one, we did have the opportunity to interview the purchaser and see what their assumptions were regarding that sale. And then I'll just skip ahead to page 22. So page 22, 677 Maryland, the city is using the older sale, and there was another sale right at the reference date, so that would be more pertinent to our valuation. And then 700 St. Mary's and 32 Arden, there's indication that there may have been intent to renovate, which would make them inappropriate for a cap rate study. And we have all of our backup data and stabilizations here, and I'll just leave my rebuttal there, but can I ask that we apply it through to the rest of the items.
That would be prudent. Thank you very much.
Thank you.
Questions, Alyssa, for the applicant?
No questions.
Thank you very much. Ms. Verheyen, any questions?
And Mr. Chair, thank you.
Thank you very much. Mr. Sealer, any additional questions, sir?
No questions, Mr. Chair, thank you.
Thank you very much. And the only question I was going to ask you is, were you able to get multiple years of information to do your recalculation on some of these properties that the city has come for?
Yeah, we were, so on page 5 where we've done Sargent, we have 3 years of expense data. For 150 Hendon on page 8, we also have, we've utilized 3 years of expense data. And yeah, so those are the ones we have 3 years. For our own stabilization of Maryland, we use single year.
Ultimately, though, would you not agree with me that when you have 2 or 3 years worth of income and expenses, that you're going to have maybe a better picture financially of the property truly at the end of the day?
I
As
would
opposed to 1 year alone?
More information would
Would
always
always
be
be better.
preferred, but I would also say that when we do have a single year, you could typically also tell by the amounts of things, whether something really seems out of line. So, for example, if your utilities are showing at like, 40%, then you would know that something's off. So yes, I would agree. We've also just kind of used our market knowledge too, where we only have a single year to determine what's appropriate.
Fair enough. Thank you.
Thank you.
And now, Alyssa, I believe you have some additional rebuttals, so would you like to walk us through your rebuttal, please?
Yeah, so for the city of Winnipeg's rebuttal to the Altus 2025 cap rate sales analysis, looking at page 12 of their study, we can notice that for sales 1 to 3, there's only 1 year of income and expense information. And it's insufficient to calculate a stabilized net operating income based on 1 year of income and expense information by our standards. And sale number 4, there isn't any actual income and expenses involved in the calculation of the net operating income. So that would also be unusable in our opinion. And sale number 5, the potential gross income utilized by Altus is not based on historically reported information. It's incorrectly stabilized. So going to page 2, looking at a more in-depth, view of the 345 Talbot Avenue stabilization. There's only, again, 1 year of income and expense information, and the Altus calculation of average rent levels are inconsistent with the rents reported in prior years. So it seems like the cap rate is inflated in a sense. And then going to page 4 for 677 Maryland Street. Again, there's only 1 year of the income and expense information, and the calculation for our average rent levels is inconsistent with the rents reported in the prior year. Going to page 6 for 738 St. Mary's Road. Here, there's again only 1 year of income and expense information, and that's insufficient for determining a cap rate. So we would also consider this an unusable sale, just like the other 2. And again, the Altus calculation for average rent levels are inconsistent with the rents reported in the prior year. Looking at 100 Maryland Street on page 9, we don't actually see actual data. Page 10 for 2390 McPhillips Street. The Altus calculation of average rent levels are inconsistent with the rents reported in the prior years. This one does have the 3 years of stabilized though. And I guess Page 11 shows how the city of Winnipeg would have stabilized 2390 McPhillips. And that would conclude my rebuttal. Thanks.
Thank you very much. Ms. Cates, questions at this point?
Yes, just a couple, thank you. So in terms of the comment on unusable, that's not based on appraisal theory or IAAO standards, is it?
I think that is just, I guess, it would be a discrepancy from how we, the city, would stabilize. So I wouldn't know if that's, in a sense, unusable by the IAAO standard. But the city uses 3 years of income and expense history when stabilizing properties.
Okay. I think that would conclude my questions. Thank you.
Thank you, Ms. Cates. Appreciate
I would
it.
ask that, I guess, this rebuttal be carried forward as well.
Yes, of course, Alyssa. We
Thank you.
appreciate the fact that we can bring it forward to the rest of them. Thank you. Ms. Verheyen, any questions?
None, thank you.
Mr. Seeler, any questions?
No questions, Mr. Chair, thank you.
Thank you very much. And I don't believe I have any further questions. So with that, any summary from either party, this afternoon, ladies, on this?
No, thanks.
I'm good as well. Thank you.
Thank you very much. This concludes this property for the sake of the hearing. Bear with me for a moment. Now we move on to item number 3, being 1050 McGregor Street. Alyssa, may we have your presentation, please?
File number is 24-1509. Roll number is 11032309600. The address is 1050 McGregor Street. The owner is William K. Butler, Timothy C. Melton. Roll year is 2025 with the reference date being April 1st, 2023. The assessed value is $6,324,000. This is Res 2 and taxable. The apartment has 1 building on site, which is 3 stories. The actual year built and effective year built are 1970. There are 48 suites and 48 outdoor parking. Sorry, just gonna get some water. Going to page 3. We can see the income value summary. So for our number of units, we have 39 1-bedroom units and 9 2-bedroom units. The average monthly rent per unit is $1,073. Looking at the model assessment, we have gross potential rent at 618,365. Our vacancy rate here is 3% applied. We have an effective gross income of 599,814. The expense rate here is 44.65%. The net operating income is 331,997, and we have a capitalization rate of 5.25%. Our estimated market value is $6,324,000. The market value per suite is $131,750. Going to page 4, we can see that all our apartments, most of them are 3 stories, except for comparable 3, which has 2 stories. The effective year built for the comparables range from 1970 to 1987. Looking at the suite mix, we have primarily a suite mix of 1 and 2 bedrooms for all the comparables, with all having more 1 bedrooms than 2 bedrooms, but not in the same ratio as the subject itself. The gross floor area per unit for the subject is 894 square feet, and our comparables are larger, ranging from 960 square feet to 1,093 square feet. The rent per unit monthly for the comparables ranges from $1,108 to $1,287. And aside from comparable 1, the other comparables do not have heat and rent. Going to page 5, we have our capitalization rate evidence. So the following is a sample of actual sales that took place during the reference period. The purpose for showing these individual capitalization rates is to illustrate the accuracy of the model. My page just had an issue. 1 second. Sorry. So the following is a sample of actual sales that took place during the reference period. The purpose for showing these individual capitalization rates is to illustrate the accuracy of the model and substantiate the model-derived capitalization rates. They are not meant to be comparable specific to the subject property. Net operating income has been developed through stabilizing owner-reported income and expense information. Capitalization rates have been derived by dividing the property's net operating income by its sale price. So here in the table below, we can see that there is a cap rate range ranging from 3.46% to 5.74%, and the subject's at 5.25%. So it falls within the range. Page 6 shows more capitalization rate evidence. So looking at the city of Winnipeg's 20th and 80th percentile for multifamily, we can see that 20th percentile is 4.75 cap and 80th percentile is 5.45 cap. So again, the subject cap of 5.25 falls within the range, as well as for the low-rise Colliers and Cushman and Wakefield and CBRE. Page 7 is the Municipal Assessment Act excerpts. Page 8 shows an aerial view of the subject property on the corner of Layla and McGregor. Here below on page 8, we can see the map view, so it's in a good area. Page 9 shows some online information for the subject property. So it's within walking distance to Kildonan Park. There are bright windows, on-site laundry, outdoor parking, and it is near the Garden City Shopping Center. The neighborhood offers walking distance to Safeway, Superstore, Garden City, Seven Oaks Hospital, several major transit routes. Page 10 shows online photos for the subject property. So it looks fairly good condition. The floors look nice. And page 12 would be the 2022 mailer information with the multifamily. Page 13 shows the financials. The model NOI was $331,997, and looking at the financials provided here, we see on page 14 that there's a total mortgage payment for $219,732. So that would have to be removed from the expense statement because that's not a typical operating expense that we would consider. So when removing that from the expenses, our NOI becomes, I believe, just quickly punch it in the calculator. Our NOI is coming in at $330,631. So that is in line with our model NOI. That would conclude my presentation. Thank you.
Thank you very much. Questions, Ms. Gates?
I have no questions. Thank you.
Thank you very much. Mr. Seeland, questions?
No questions, Mr. Chair. Thank you.
Thank you very much. Ms. Farhan, questions?
None, thank you, sir.
Thank you very much, and I do not believe I have any questions either. Ms. Gates, you're up.
Thank you. So if you turn to page 2, we have our requested assessment of $5,694,000. On page 6, we have our property maps. And then page 7, some exterior photos. And then a pictometry view on page 8. Page 9, property description. So the subject property is at the intersection of McGregor and Leela in the Margaret Park area. It is a 3-story building built in 1970 with 48 units, 28 surface parking stalls, and there is 1 parking stall included in the rent of each unit. And the property is adjacent to the rail line. If you turn to page 14, we have the overview of our income approach. So we are applying effective gross rents of $562,282 based on the income of the property. In terms of the way they report as effective figures, so it is already including vacancy, so no additional vacancy allowance has been applied. For the expenses, we stabilize 3 years of operating expenses along with 5 years of repair and maintenance. So we're using $263,363 or 45.7% of EGI. On page 15, we have our cap rate for the subject. So the property was built in 1970. That would give a base cap rate of 5.5. We know there's nothing out of the ordinary about the property. We've not done any further adjustments. The finishes based on kind of just looking at the marketing photos would be somewhere in the neighborhood of average to good. We note that there is a little bit of a lack of parking at the property, but we've not done any adjustments. And when we look to what the market is saying for these type of properties, the brokers are pretty well saying for the low rise B stuff, 5 to 6, 5 to 5.75. So being at 5.5, we're right in that range. On page 17, we have our income and expense breakdown. So we stabilize income based on the most recent year. So we have an effective gross income of $576,557. For the expenses in the remarks, we put if we've taken an average or a percentage, and if nothing stated, we've stabilized based on the most recent year, as certain expenses are just always seen to go up and others are seen to fluctuate more. So our stabilized repair maintenance can be found on page 18. So we've taken a look at it line by line, and we have $14.41 per unit. That would be fairly standard for an apartment, potentially even on a bit of the low end. But given that it is just more of a kind of average apartment, that would make sense. So we have an NOI of $313,194 with a 5.5% cap rate, gives an indicated value of $5,694,000. On page 20, we have our appendix. So I've just included the marketing photos that I saw. So some of the floorings look a bit new, but in terms of the kitchens, look a bit dated. So fairly standard 70s apartment, I would say. And then just the financials that we've looked at as well. And that would conclude my presentation. Thank you.
Thank you very much. And questions, Alyssa?
So looking at your page 17, I'm just noticing that the EGI for the 22 year is not, I guess, consistent or the same as what we see on page 25 for the revenue on the mailer. Any specific reason not to include the property tax refund?
Well, we include the taxes, after rebate, so. We don't put the refund as income. Cause if you see the property taxes, if you go to page 17, how they're consistently going down, whereas typically they would go up, so that is reflecting the rebate in there, so if you're accounting for it in the taxes. In the expense, then we wouldn't also account for it as an income, and that's standard with how we treat. The apartments.
Okay, no further questions.
Thank you. Ms. Verhun, do you have any questions?
None, thank you.
Mr. Thielen, questions?
No questions, Mr. Chair, thank you.
Thank you very much. And I do not believe I have any questions for you, so. With that, unless you have summation, ladies,
I'm good, thank you.
No summation, thanks.
thank you very much. This concludes this item on the docket today. And the last item. In item number 5. That is 150 Addison Drive. Alyssa, can we hear your presentation on this, please?
File number is 24-1262. Roll number is 0500455890. This is 150 Adsum Drive, and the owner is Green Enterprises Limited. Roll year is 2025 with the reference date being April 1st, 2023. The assessed value is $5,648,000. This is Res 2, taxable. The apartment has one building on site, which is 3 stories. The actual year built and effective year built are both 1975. We have 60 suites and 70 outdoor parking. Going to page 3.
That's 61 suites.
I believe it's 60. I think if we go to page 3, the income value summary, the number of units that's tally is totaling 60. So we have 24 one bedroom and
Yeah, I see that,
36.
but yet on your page 1.
Yeah, on the initial page, it does say 61.
So you're certain that it's 60 then? You're comfortable with that?
I'm comfortable with 60.
Thank you very much. Just wanted to confirm. Thank you.
And anyways, so 24 one bedrooms and 36 two bedrooms, totaling 60 units, and the average monthly rent per unit is $905.30. Looking at our model derived assessment, we have a gross potential rent of $651,816 with 3% vacancy rate applied, and our effective gross income is $632,262, and the expense rate applied here is 51.76%. The net operating income is $305,003. We have a cap rate of 5.4% applied, and our estimated market value is $5,648,000. Market value per suite is $94,133. Going to page 4, we have our rent comparables. So looking at I guess the comparables and the subject, they're all apartments. They all have 3 stories and they range between having 1 and 2 buildings on site. The effective year built for the comparables ranges from 1979 to 1988. The suite mix here is that of 1 bedrooms and 2 bedrooms, with all the comparables having, except for comparable 4 having more 2 bedrooms than that of 1 bedrooms, and comparable 4 has more 1 bedrooms than 2 bedrooms. Subject has more 2 bedrooms than 1 bedrooms. And looking at the gross floor area per unit, the subject is at 1,172 square feet. And for the comparables, it ranges from 919 square feet to 1,383 square feet. The average monthly rent per unit for the comparables ranges from $1,016 to $1,108. And what we can note here is that the heat and rent is not included. Going to page 5, we have our capitalization rate evidence. The following is a sample of actual sales that took place during the reference period. The purpose for showing these individual capitalization rates is to illustrate the accuracy of the model and substantiate the model-derived capitalization rates. They are not meant to be comparable specific to the subject property. The net operating income has been developed through stabilizing owner-reported income and expense information. Capitalization rates have been derived by dividing the property's net operating income by its sale price. Looking at the table, we see the ranges from 3.46 to 5.74%, and the subject is at 5.4%, falling within the range. Going to page 6, we have more capitalization rate evidence. So looking at the city of Winnipeg's multifamily, we have the 20th percentile 4.75 and the 80th percentile at 5.45. So again, the subject is within the range, closer to the 80th percentile. And it's also within the range for the other brokers in the low rise. Page 7 is the Municipal Assessment Act excerpts. Page 8 shows in the purple box the subject property's aerial view, as well as the location on a map. So it's in a good neighborhood. Page 9 shows the subject property online information, and we can see some exterior images and a little description of 150 Adsom Drive, the building. So in the Maples neighborhood, just blocks away from grocery stores, restaurants, schools, parks, the Garden City Shopping Center, and many other neighborhood amenities. Suites aren't available often at this charming 3-story walk-up, so it seems that they also have, I guess, heat, hydro, parking, water, cable included in the rent. Page 10 would be the 2022 mailer for the multifamily. You can see the gross potential suite income is at $722,039. Going to page 11, we can see another page of the mailer. Page 12 has the financials. And we can see here that the total revenue is saying 833,362. I guess the line for miscellaneous income realty tax refund doesn't seem typical, so I wouldn't consider that in, I guess, in the revenue. And then looking at the expenses on page 13, it seems that there is some capital for the building exterior. Just need to, oh, sorry, that's on page 12. So for building just give me a second here. I'm trying to, I guess, find the line that I'm looking for. Guess that's what happens when I don't highlight things all the time. Okay, so sorry. Found it. Page 13. There is a line for renovation building exterior for $241,000. Well, and $80, and that would be capital. So we would not consider this, I guess, a typical operating expense either. And that being said, I just want to, I guess, punch in my calculator quickly, something for seeing what the NOI would be like without some of those lines that I mentioned. Okay. So going back to page 3, we have our NOI coming in at $305,003, and looking at our I guess, considering, I guess, the mailer for 2022, it seems as though the NOI is coming in more so at 191,000. So I think I would make a verbal rec on this one, actually. Just because it seems that
Listen, you need a couple minutes just to work it through, and that
I
way you're
think
not
I
having to
do.
sit here waiting for you. If you want to take a break for 5 minutes, we can.
Yeah, I would greatly appreciate that.
All right, let's take a 5 minute break. If you need more time, we'll figure that out as we go along, but we'll do that now. Thank you.
Thank you.
Thank you very much. Welcome back. Melissa, I believe you were doing.
I have a
some
recommendation, yeah.
recommendations for us?
Okay, so the recommendation would be to, I guess, use the Altus NOI stabilization for 265,562 and applying the City of Winnipeg cap rate of 5.4% to that to get to an assessment of $4,918,000.
All right, so you're going to 265,562 for the NOI,
Correct.
which is the Altus. And in this case, do you have some interest in this?
I accept.
All right,
There we go.
that was simple. Okay, so just let me make sure I get all the numbers correct for this, 265,562, and the cap rate that you're using, Alyssa,
Correct.
is how much?
Is 5.4%.
Okay. And the revised value is
$918,000.
4,018,000 rounded out,
Correct.
and well, with that then, I thank you very much both. I believe we can, unless we have, well, maybe we should go through questions just in case. You have no questions.
No questions.
Mr. Sealand, do you have any questions just in case?
Thank you. No questions, Mr. Chair. Thank you.
Thank you very much. Ms. Ferran, do you have any questions?
I do not, Mr. Chair. Thank you.
And I do not have any further questions. And since Ms. Cates is accepting the verbal recommendation, then we will consider this matter closed and we will move on. So, ladies, thank you very much for your time and your help today and your patience as usual. With that, I believe we've heard all the items scheduled and this meeting is now adjourned. Thank you very much.
Thank you.
Thank you. Have a good day. Bye.
Have a nice
Thank you very much. Enjoy your